let's move to the company's credibility. Each country has some commercial law or business law. The name could be a bit different, but there is such kind of law. And look at what are the requirements in the commercial law. For example, there could be a requirement for some minimum share capital. In Estonia, the minimum share capital is 2,500 euros for private limited companies and 25,000 euros to public limited companies. Or there could be some requirement to form some legal reserves, some mandatory legal reserves that, for example, 5% or 10% of the retained earnings you need to move to legal reserve. It means that the company cannot distribute this as a profit. Or there could be some extra requirements of the equity. For example, here in Estonia, the equity, total equity has to be at least half of the paid-in capital. It means that the company cannot earn more loss than half of the paid-in capital. And additionally, the total equity has to be at least 2,500 euros. This means that if you started your company with paid-in capital 2,500 euros, you cannot earn loss. If you have a loss, you need to increase the paid-in capital. The quality of financial statements, you need to ensure that it's in line with the laws and that this is where the auditor helps us as they do this work. Under understandability, this means that you cannot use the specific vocabulary of your industry. Probably when you have started working in a new company, the first month you try to survive to understand all the abbreviation and the corporate slang they're using in that company. But it's not allowed to use that in the annual report. So annual report has to be understandable for everybody who understands the basic financial vocabulary. It means that objectivity, it means that you cannot too much emphasize your little wins, and it's not allowed to minimize your big challenges. Comparability means that the annual reports, when they are published, they have also information about the base year. So there are at least 2 columns with financial data, and it means that the base year data and current year data, they has to be prepared using the same accounting principles. Because the companies are allowed to change the accounting principles, it means that if this has happened, the company needs to recalculate the previous period financial statement as well. So this is the comparability. Selection of the fiscal year. In European Union, we have 12 opportunities to choose a fiscal year. You can start every day 1 of each month. The most common here in Estonia is that fiscal year is similar to calendar year, but there are other 11 other opportunities legally available as well. Now, what is the recommendation is that the company should select the fiscal year based on their seasonality. So it is advised that you should finish your fiscal year at the beginning of low season, because in that case your inventories are the lowest, your balance sheet total is usually the smallest, and the company looks more efficient. But this we will deep dive more in the financial ratio analysis. In North America, for example, it could happen that the company's fiscal year will end, for example, last Sunday of the April. Because in North America it's allowed that instead of 12 months, you can have 13 4-week periods. It means that the fiscal year in that case is 52 weeks, and every fourth year 53 weeks. Why this is used, especially in the retail business, is to ensure comparability. Because when you have 4-week periods, you have 4 Mondays, 4 Fridays, 4 Sundays in your reporting period. And it's much easier to compare with previous year when you have a similar number of weekends or similar number of work weeks in your period. In European Union, we need to bear in mind that this could impact how many working days we have in the month or how many weekends we have in the month compared to a previous period. Quality of risk assessment. Enterprise risk management is another course, but as an analyst, have a look how the company is explaining their risks. At minimum, they can explain the financial risks like interest rate risk, if they are open for the interest rate risk, because if the Euribor, for example, is increasing, the interest expenses will increase and net profit will be decreased, and all the ratios related to net profit will decrease as well. Or if the company is open for the currency exchange fluctuations. If you operate in the countries where the currencies are fluctuating, it's very volatile, this will have the impact to the financial performance because you can have gains and losses from the exchange rate differences. Thirdly, you can have credit risk. It means that if you have credit sales and you are not able to collect money from your customers, in that case your credit risk is increasing. And credit risk is a pair with liquidity risk. Liquidity risk means that you are not able to pay to your suppliers. It means that your liquidity risk is the credit risk of your supplier. So have a look what the company is doing to minimize the negative risks and maximize the opportunities from positive risks, because risks could be either positive or negative. Or sometimes the companies say that we are aware of these risks, but we don't do anything. We will start doing when the risk will really realize. Next, selection of the accounting principles. In some cases, it is allowed to choose between accounting principles. Different accounting principles were discussed in the financial accounting course. Just one example here, that when you have real estate in your balance sheet, it could be either booked with acquisition cost, it means in historical value, or it could be booked with fair value. Usually the fair value is measured what is the current market value of that asset. It is advised that if the land and real estate is used for the main activities, for the core activities, in that case it's advised to use historical cost or acquisition cost as an accounting principle. And for these land plots and properties the company is not using for main activities, then the fair value could be better accounting principle to show the reality. If the company is using acquisition cost method, then the company needs to calculate depreciation and amortization from the fixed asset. And the company can decide, in many countries, the company can decide how fast or how slow they expense their assets. So the selection of useful life will determine the depreciation speed of the asset. And if it's a fair value method, so how the company is measuring the fair value, the risk is that if the real estate market goes down, the company is blaming that, yeah, we know that the market is going down, but these are not influencing our business so much. No, usually that's not true. And last one, risk of black salaries. It means the salaries where no taxes are paid. So if you calculate the average salary of the company, then and if it's close to the minimum salary of the country, then there is a quite high risk for the black salary, because average salary of the company is the average of first level positions till top level positions, and it cannot be close to a minimum salary. Because if there is a risk of minimum salary, it means that or a risk of black salary, it means that the numbers are biased, and it doesn't make sense to analyze the biased numbers. Have a look if the company has any contingent liabilities. It means that any potential liabilities, if they could materialize, what could be the effect on the business performance? For example, the company has some court case in the middle, and if there's already more than 50% probability that the company will lose this court case, so you can do your calculations how the financial performance and financial position will be affected by this extra expense and extra cash outflow. So these are the contingent liabilities. It means that potential liabilities, what could materialize in the future. Have a look what is the remuneration of the management and supervisory board, and if it makes sense for you from your point of view. This is usually published for the stock-listed companies. For non-stock-listed companies, usually you don't have this information available. And about the transactions with related parties, it's for the analyst point of view, it is important that you will find a sentence saying that the transactions with related parties are done with market prices. Because in real life it could happen that when you have a group of companies, there is an idea that, okay, let's show this company A more profitable and company B less profitable for some reasons. But if this is manipulated that way, it doesn't make sense to analyze these companies as the data will be biased. And also the tax legislations are pushing that the transactions with related parties are in market prices, and this is done through transfer pricing regulations, what are taught in international taxation. So these were the ideas to look at as well before starting your analysis.